Welcome back. Well, let's talk about some stocks then. We have Dipan Mehta now joining us, director at Elixir Equities, now joining us in our studios. Dipan, hi, good morning. Thanks for joining us.
Thanks for having me.
I wanted your thoughts first on these metal names, JSPL and NMDC, both in news today. What would be your view on both these stocks?
I think both are positive, and we are seeing a cyclical upswing in all commodities post the US-China deal, which has taken place. And I think after many quarters of soft prices, we are seeing uptick across the board in a lot of metals, ferrous as well as non-ferrous metals. With JSPL also you have the advantage of rising volumes as well because of the new expansions which have undertaken a couple of years ago. I think those plants are scaling up pretty well. And also they are more in long products, to that extent they benefit from infrastructure spending more than some of the flat rolled steel product companies. NMDC, I think, it's more to do with prices of iron ore, and those also have improved globally. So yes, I think next 2-3 quarters looks good for steel companies, and valuation still attractive. I think both trading near about book value or thereabouts. So there's certainly scope for appreciation.
Okay, Dipan, hi, good morning. So, the important takeaway, at least for me so far this earnings season, has been that both the large banks, HDFC Bank and IndusInd Bank, have reported weakness in their retail portfolio and higher slippages. So, HDFC Bank as well has reported their slippages at over 5,300 crores versus 3,700 crores last quarter. Would you be concerned here, and what would you do with these two names now?
See, I think you have to live this period out, I think, because stocks like HDFC Bank, if you try and sell them, trying to buy them back again, is a bit of a mindset issue. So, I mean, having been invested in HDFC for decades, it's better to just, see through these soft quarters. But one point I think in HDFC Bank is that the unsecured loans, which is the bigger concern as far as analysts are concerned, that the NPAs over there remained well under control. So that was stable. And I think it's a passing phase. And eventually, I think provisioning will come off. I think they still did report a 20% pre-provisioning profit increase, which is quite admirable given the base at which they are operating at. And once you have credit costs slightly coming off, then you will see the growth coming through in the actual earnings per share of the company as well. And the present scenario favors large banks like HDFC Bank, considering that a lot of other peer groups in the private sector and PSU banks are still on a weak footing. So, I mean, I know it's a bit of a disappointment. You may see a 5-10% correction in HDFC Bank, but I don't want to sell into this correction. I would just like to hold and see maybe for a quarter or two. I think the story is certainly not over for HDFC Bank.
And Dipan would say that because Dipan ran the half marathon yesterday, Dipan and Jakes both, and seen, of course, the kind of fitness that Dipan has, and especially over the last 10 years. In fact, I've seen a lot of market people over the last 10 years get into marathon. And that's something that even I hope at some point I will be able to achieve. But this mindset comes from running a marathon. When you run a marathon,
and the discipline that you give.
It's all about patience.
And you don't want to sprint. You don't. And generally a successful marathon runner would start slow, and then through the time keep improving the laps. And the last lap, of course, will have to be the sprint. And that's what a lot of good stocks do in the market parlance. So I guess that also helps.
Many learnings from running a marathon.
Many learnings.
Was this your first time, or have you run?
No. This is my 8th half marathon.
He's been running a lot of marathons. He's a regular marathoner, of course. So that clearly is something which perhaps helps. But a stock which has had a sprint is Ultratech Cement. In fact, the cement sector is making a comeback, and we saw She Cement, Ultratech, Kakatiya Cement. It's just a relentless run in some of these stocks, Dipan. Any picks here?
I think so. I think very positive on cement, and I would like to place cement through the mid-cap stocks. So I think Ultratech, She Cement, valuations are a bit discomforting the way they're trading, like beyond FMCG price to earnings multiples, considering on a trailing 12-month basis. So I think companies like, say, Birla Corp or Ramco Cement, India Cement, which are still available at reasonable valuation, even ACC, which is available at reasonable valuation. I think that's where the scope for appreciation is there. The risk-return ratio favors you, and I think earnings across the sector should move up as volumes pick up. They've done a great job as far as their input costs are concerned, and of course there is an element of price discipline in cement companies. And I think that as volumes and profits start looking up, there's scope for PEs to expand as far as the mid-cap stocks are concerned. When you look at Ultratech quoting at the PE as an Birla Corp at maybe 60-70% of the same PE, you feel intuitively that that's where the appreciation would come over the next few quarters or so.
Okay, well now let's talk about the heavyweights, right? Reliance. I know we've talked about this endlessly, but this time around there was a bit more to complain than the previous quarter. So, slowdown in the petchem business, GRMs were just about okay. RelGeo as well, not as good as what the street was expecting. You think it could cause a bit of a jitters in the stock, or because of this whole AGR verdict, etc., it's just one way up for Reliance?
See, I think market understands the petchem and the refining business very well. These are cyclical businesses, and it's a soft quarter globally, and it's still an efficient player over there. At 2-3 quarters down the line, we may be saying that okay, these businesses are now contributing significantly back again. But I think the story as far as retail and telecom is concerned, that remains intact and very strong. And the fact remains that in Reliance Industries, now the proportion of high PE businesses is gradually increasing as compared to the low PE businesses, and that will support these elevated valuations. So I think that the party continues in Reliance Industries, and there is more news flow to be expected as far as unlocking of the value of the telecom and retail is concerned, and any debt reduction plans which they have.
Fair point. And since we are discussing Reliance, let's discuss it even in more details. Harshvardhan Dole of IIFL is now joining us. Harsh, good morning. Thanks for joining us. Your first thoughts, because it was a bit of a mixed bag. What would be your call on the stock now?
Hi. Of course, the results were sort of mixed bag. While the petchem was worse than what we had expected, partly it was offset by refining. And of course, retail and Geo continue to surprise positively. So post the results, we have tweaked our this year's numbers by about 4.5%, and upped next 2 years' numbers by about 5 to 9% to reflect the performance of the core business and the tariff hike that Geo has taken. So our SOTP stands revised to 1725, and RIL is our top pick in the sector.
Okay, RIL is a topic in the sector. Harsh, hi, good morning. Now the consumer businesses, both Geo and retail, account for 38% share in the consolidated EBITDA versus much lower earlier. So on both these businesses, on Geo as well as on the retail, what is your prognosis? I mean, do you expect better growth, and how much would you attribute it as a percentage of the overall business, say 6 to 12 months from now?
So, going out in 21 and 22, retailing and Geo will be the primary growth drivers for earnings, and large part of maybe 70 to 80% of the earnings growth will actually come from these two entities, albeit their contribution in the overall EBITDA will go to as high as 40% in about 21, 22. So the overall contribution to EBITDA, which is currently 35%, should go to almost 40, 41%, maybe 2 years out. So the valuation of stable, high PE businesses in the overall SOTP will actually stand to gain materially.
Okay. Harsh, how critical is this, timely closure of the Aramco deal, and what are you building in?
So frankly, the management has never guided for a specific timelines of Aramco closure, but our sense is the deal is in the advanced stages, and I'd reckon that it should get completed in next maybe 12 months' time, if not in next couple of quarters. That's it. Our numbers don't build in any upside, either form of debt reduction or possible synergies from this particular deal. And as and when this deal happens, we look forward to tweak the numbers and change the SOTP.
In fact, I was going to ask you the same question on whether this 1725 target that you've put out, does it factor in the increased possibility of a consolidation in the telecom sector post the AGR verdict?
Certainly, yes. So we have taken into account increase in ARPU for Geo, and our current SOTP, which factors in an EV of $75 billion to Geo, builds in 153 rupees of ARPU in FY21. My sense is if the current consolidation continues, there is a good scope for the overall ARPUs to go up, and the sensitivity of ARPU to the SOTP is fairly high. For example, if the Geo's ARPU changes by 10 rupees, the overall SOTP moves up by almost 50 rupees a share. So it is quite sensitive to the underlying ARPU assumptions.
All right, Harsh, we leave it there today. Thanks a lot for joining us. So that's the view on Reliance. Once again, standard disclaimer, Reliance owns the companies that run the channel that you're watching, CNBC TV18, your favorite business channel. We'll do one thing, we'll take a break, and up next we'll get you the technical advice as well from our technical experts, and we have, of course, Dipan